The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Investing is often seen as a numbers game, but beneath the charts and forecasts lies something far more unpredictable: human behavior. Why do some investors go all in on a single stock? Why do we hold on to losing positions, hoping to get back to even? And how can a simple mindset shift, like embracing partial action, transform our long-term outcomes? Well, to find out more, joining me now is Steve Brice, Global CIO of Standard Chartered. Steve, welcome to the show.
Thank you so much. Great to be here.
Thank you so much for joining us. Well, Steve, you've warned against an all-or-nothing approach to investing. Why do you think this mindset is still so common among investors today?
There's so many reasons. I guess a couple that come to mind are, firstly, obviously, when we go through the education system, we're all taught there's a right and a wrong answer. And therefore, I think it's ingrained in us to try and find the right answer to any question, such as what I should be investing in today. And the second one is that we're suckers for stories. So this is one of the reasons that themes are so popular. The themes, when people can buy into them, everybody understands that we have a demographic aging, or we're shifting towards a carbon neutral, trying to shift to a carbon neutral environment. Everybody knows these are long-term themes, but by the time they get there, the valuations are so high. So it might not be a great investment at that time. So I think it's really just gives everybody a very narrow investment, and that can be very gut-wrenching in terms of the volatility experienced.
Okay, so what are the psychological traps that, lead investors to hold on to concentrated positions even after significant losses?
Well, I guess the key one is the endowment bias that we have, right? So, we know that when we own something, we become more emotionally attached to it than if you don't own it. For instance, so let's say you're given a mug and you might say, oh, that mug's worth $10. Whereas actually, if you saw it in a store, you'd only pay $5 for it. That's effectively the endowment bias. And that can happen in investing as well. So we know that people hate to lose money more than we like to make money. Now, taking a loss obviously does two things. It allows you to forget about it and move on, but it also means admitting you're wrong. So I think those are the sort of things that we need to think about, ideally, before we make an investment and say, okay, if I make this investment and I have different scenarios of what could potentially happen, how will I react to that?
Okay. So how do you help clients then shift their mindset from binary thinking to a more probabilistic approach to investing?
Yeah, so I guess it comes from trying to think about things in a scenario-based approach. So trying to think about, over different time horizons, what could potentially happen. So if you think about a company, you're invested in a stock, it could go bankrupt. It's possible. You may not feel it's very likely. Obviously, if you did, you wouldn't be investing in it. But you're just trying to say, okay, what's the potential outcomes and what's the volatility of those? And that helps you then think about right-sizing the investment or averaging into investment or whatever you need to think about. So another thing to think about, as I mentioned, is the volatility of the investments. So the example I always give is my eldest son, who was investing in stocks, diversified stocks, but 100% in stocks. He knew conceptually what it was like in terms of, yes, you can see 20%, 30%, 40% drawdowns, but until he experienced it, he didn't know how he would feel about that. So part of this, learning by doing as well.
Okay. Well, then, once we understand the emotional side of investing here, the question becomes, how to structure a portfolio that's resilient to those emotions. Now, Steve, you cited data that a 60-40 portfolio hasn't lost money over any 5-year period since 1950, but how relevant is that track record in today's macro environment?
Yeah, I guess I'd sort of say three things. 75 years of data is a very long period of time, so that gives you some comfort. If you had that over a 20-year period, you'd have less comfort than 75 years. But obviously, does feel a pretty different environment at the moment. And I guess the way I'd look at this, I'd look at two sides of the argument. So firstly, the volatility that we're seeing in the current environment is largely man-made, and we think that we still have the Trump put out there, so that if we did see some weakness in markets, then policies would change to try and support the market. But on the other side, you've got inflation does seem to be structurally higher in this environment. So obviously we've seen that since 2022. We're likely to see inflation, at least in the US, pick up again as we go through this year as the tariffs start hitting. And that does change correlations between asset classes. So bonds and equities, the correlation is typically negative. So if bonds are doing well, then equities are usually doing poorly and vice versa. In a high inflation environment, then the correlation can be positive. So if equities do badly, then bonds can do badly at the same time. So it's really important not just to focus on this 60-40 sort of portfolio, but then diversifying to as many assets as you can. So whether it be gold, private assets, or hedge funds as well, just to try and get as much diversification in the portfolio as possible.
Then how do you balance between staying invested for the long term and managing risk in the short term?
So I think most people struggle with this, right? So you need to almost have extreme fortitude to just be fully invested at all times and just then, sit through all the short-term volatility. So I think about, different tricks of the trade to try and do this. So I think when people are stressed, they generally want to do something. So if you're fully invested, the only thing you can do is sell. So one trick is to have some cash on the sidelines to say, okay, encourage yourself to think about the opportunity that markets are providing in terms of increasing your investments. The other trick actually that you can use is to look at your portfolio valuation in different currencies. And I think that's particularly pertinent now for Singapore investors. Obviously, the Sing dollar has strengthened, which has undermined the performance of portfolios in Sing dollar terms. So if you then say, okay, let's look at it in different currencies, let's look at it in the US dollar or maybe the euro or whatever, then maybe you sort of say, okay, fine, yes, this is largely a currency effect, not the performance of the underlying investment. And that might help you see through the cycle as well.
I mean, even with a sound strategy, though, Steve, emotional hurdles remain. So let's talk about navigating those difficult situations. So when investors or your clients ask, what if the stock rallies after I sell? How should they, reframe that question?
So obviously this is a valid concern. And I think what I'd sort of say is there's a lot of research that talks about regret by commission and regret by omission. So regret by commission is regret of doing something, and regret by omission is regret of not doing something. So, and people generally have, if you take an action, you get greater regret than if you didn't do something, even if both were the wrong thing to do. So maybe just think about that ahead of time and sort of understand that, and then say, okay, fine, let's say I've got $100 in this stock. I want to manage that down to $10. Maybe I'll sell $20 or $30 now, and then see what happens. And if the stock goes up, then you can sell into the rally and get better valuation. So you're just tricking yourself to say, look, I didn't do something 100% wrong. I've done something and I'm still benefiting from being partially right or partially wrong.
Well, then what role does emotional resilience play in sticking to a long-term investment plan, and how can investors cultivate it?
So I think this is the game. So if you can manage your emotions, then you will most likely be a successful investor. So two things I'd say is, firstly, have an investment plan that is written down and review it constantly as you go through your investment journey. Of course, you can tweak it, but realize why you have that plan and the rationale behind it. And the second thing is, don't do it alone. So you can either do it with a financial advisor who can help advise you in terms of keeping you on that track, or you can do it with your partner. And I think both of those can really help sort of make sure you don't do knee-jerk things that can undermine long-term returns.
Definitely. Well, is there any example, you can share about how adopting a glass half full view has helped an investor make a better decision or stay the course?
So I guess, it certainly helped me through life. I generally try and get excited when markets are selling off because they have gone on sale. So I think, in April, we accelerated our investments, not because we thought markets had bottomed, but we thought because they'd gone on sale. And if they went on more sale, then we'd have done more. So I think that certainly helped. I think the other thing, just to understand, and again, acknowledge this ahead of time, is that stock markets will at some point in the economic cycle fall 40 to 50%. And so whenever you're making decisions about what to invest today, you should factor that in. We don't know when it's going to happen or from what level, but just acknowledging that will happen at some point, I think can help you be measured in whatever you do from an investment perspective.
Definitely. You also highlighted that market downturns like the COVID crash or the 2022 sell-off were, relatively short-lived. So should investors always buy the dip, and how do you judge when it's truly an opportunity?
I think if it's it's a diversified portfolio and you know you won't need the money for over 10 years, then history suggests that, yes, you should buy the dip. The key thing, of course, is to understand that you won't get it perfectly right. You won't pick the absolute low in the portfolio or in the stock market or whatever it is. So again, you don't need to do that. You can sort of say, okay, I'll invest if the market's down 10%, and then I'll invest more if it's down 20%, etc. So you can sort of then say, I'm doing it in tranches. And yeah, if you don't get everything invested, then at least you've got something in it. But it's really just try and say, okay, I'm not going to perfectly time this, and that's okay.
Right. And in cases like, the couple who lost a third of their portfolio on a single stock, what are the key steps to take mentally and financially to move forward?
The key thing is really just to understand where you want to be. So, if you have a large concentration in one stock, you need to say, okay, I want to get to here, and then I have a timeline for doing that. And then you start moving towards that. You don't have to do everything today. That can be quite daunting and quite scary. But if you don't do anything, then you're going to be faced with the same decision tomorrow. So at least start making steps towards getting to where you want to be.
All righties. And before we let you go here, Steve, for investors who want to, so-called win back their losses by doubling down, how do you counsel them to break that mindset and refocus on long-term recovery?
It's very, very tempting, right, to say, okay, fine, to double down and just say, look, I'm gonna get everything back really quickly. The reality is you don't know that the stock that has gone down sharply is going to recover their losses. We have a lot of examples in history, of course, where money has been permanently lost in individual stocks. So the key is to say, look, this is not a casino. We shouldn't be gambling our money when our financial future is at stake. And therefore, it's like saying, okay, I am where I am today. It is what it is. But I need to sort of take the lessons from that and learn how to do better and maybe slower. The tortoise will reach the finish line more often than the hare over the long term, is a lot less likely to get run over in the pursuit of quick returns.
Thank you so much for that. Thank you so much for your time and your insights today, Steve.
Thank you so much.
Thank you. That was Steve Brice, Global CIO of Standard Chartered. Now, if today's conversation resonated with you, or if you've ever found yourself stuck in the all or nothing mindset, do check out the full article on this topic. It's titled The All or Nothing Approach to Investing Has to Stop. It's written by Steve himself, and it's now available at the Business Times. So this has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.